Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, we see a real rise in the Asian consumer, and we're definitely seeing a rise in the Asian consumer, and we're definitely seeing increases in the rate of consumption throughout Asia. But if we see some type of real boom and a real reallocation of resources away from the export type of economy into consumer finance and providing all the things to drive a consumer economy in Asia, that means that these Asian countries that are export-oriented, the ones that are holding about $2 trillion in reserves and much of that in U.S. Treasuries, if they no longer have to depend on the U.S. consumer, guess what? They no longer have to hold all these treasuries. It goes hand in hand. If they have their own domestic demand, then they'll no longer be holding on either propping up the U.S. consumer or worrying about suppressing their currencies. Again, if you have a consumer economy, you're better off with a stronger value of your currency because it tends to increase your purchasing power. Also, these Asian countries import a lot of natural resources. If China's currency, for example, were to hike up 30-40% in value, that means their cost of oil and their cost of other things would fall dramatically. And also would increase the purchasing power of all the Chinese domestic economy. So we have to really watch this in a very, very big way. Again, this doesn't have to be a disaster scenario because of the fact that the U.S. is actually savings more, and I get to that in a second. But if we start to see actually a real boom in the Asian consumer, which means that countries like China would have to reduce their capital controls and let their consumers buy goods from the outside, we could actually start to see some rebalancing or leveling off of trade start to go both ways as the Asian consumer starts to want and demand and buy consumer goods from both the U.S. and Europe. So it's not necessarily always a bad thing, but it would be a major change to the U.S. to the Treasury holding pattern throughout Asia, and thus the U.S. would lose a major support, or at least a major source of purchasing or of funding, of global funding. If the U.S. current account doesn't improve and the U.S. is still reliant on international capital, this is a very, very bad thing. But I think that may be changing. So this is something that we also have to watch very, very closely. It could be a good thing or a bad thing for the U.S. dollar. Now, this is why, at the moment, I don't see the U.S. dollar in jeopardy. And again, some of these, we could do an actual seminar on one or two of these things, but I'll try and make some of the points clear and give Steve the floor here in a second. There's really no other competitor on the horizon. There's real questions. The euro right now is the alternative currency for the dollar, the major world alternative currency, and you see the euro move in a big way when the dollar falls, sometimes not because of anything going on special for the euro, but because it tends to play that role. It's the second deepest capital markets in the world. We happen to think there's some major structural problems in the euro in a very, very big way, and we don't think the euro can play that role, at least for many, many years. It's decades away, given the amount of baggage that they have trying to incorporate what they've taken on in terms of Eastern and Central Europe, and some real fiscal problems and some real, they got some major problems in terms of pensions and inflexible labor forces, even in some of the core European countries. So the currency in and of itself, I think, is structurally could be in trouble here. So we don't see that as a competitor. Obviously, China isn't there yet. We could see Japan, but again, I don't think Japan wants to play that role. We could see, again, some type of thing develop in the Asian bloc, but many, many years off right now. There really is no competitor out there. As I said, although it would be painful, the debt really can be mopped up in the U.S. economy. If, say, we have a change of administration and another regime comes in and has completely different ideas of economic policies, we could see some real initial pain in the debt being propped up. again, the perfect example of this was when we switched from Carter to the Reagan administration. This is not to criticize Carter. He was put in a situation where the business cycle was a bit intact. But what happened? And actually, Carter actually appointed Volcker. But we saw Volcker come in and put the U.S. through some real tough love. Pushed its interest rates up to 20%, squeezing inflation out of the economy. We saw a rebound in manufacturing throughout the Midwest in the U.S. and the U.S. economy, really soared from really being in the doldrums. That could happen. Again, when you see the concern that all of us have as citizens in the U.S. watching this, there's a real groundswell, I think, for a change in economic policy. So let's not count that out, that this debt can't be mopped up in a couple of years. Anyway. And this, I think, is the key point, I think really is the game changer, and why this idea of the dollar losing its reserve status really loses a lot of its viability. And in the next couple of charts, I'll get to this. We're seeing a massive change in the U.S. savings patterns, and you see that in the change in the U.S. current account. U.S. savers are going from close to negative, I guess, in the last cycle. Some say we were negative in the midst of that dollar bear market when we were buying everything from China and our housing prices were going up and we were feeling good about our stock accounts. We didn't have to save. Well, now we are saving, and we're up to about 6 to 7%, I think we are now, of GDP. What that means is when the U.S. saves, it creates a domestic pool of capital for our country to draw on. So the amount of savings that we have and the amount of increase, therefore, reduces the amount of funding we need externally. And I think you're going to see these savings patterns. This will be a multi-year thing and not some type of cyclical thing. As we saw before, and again, backtracking a little bit here to try and make this point, this is a chart of the U.S. dollar index, again, is the black line here. The red line, the red line is the U.S. dollar index. The black line is the S&P 500, and the blue line is commodities. And I just wanted to make the point here showing that as the U.S. dollar goes down, how it funded these asset classes, these asset bubbles. As the U.S. dollar is coming up, these asset bubbles are falling. It's because the globe, again, the U.S. dollar as the U.S. dollar-based credits coming out of the global economy when you see this, and you also see it. You also see it in the current account. I'll get back to that in a second. But we've seen a 50% improvement in the U.S. current account deficit right here. We see another 50%. Guess what? Our deficit, our current account deficit, as everybody said, could only be rebalanced if the U.S. dollar fell 30 to 40%, could go to zero in the next 6 to 8 months. Sounds surprising, sounds shocking, but that's the reality. And if U.S. consumers were to save 10% of GDP, U.S. is a $14 trillion economy. That's $1.4 trillion that the U.S. then does not need in terms of external funding, probably right about the amount that they're getting from China and some of the Asian countries. So this idea that we could lose external funding from China and Japan, and we're definitely going to go down the tubes, isn't necessarily the case if we see the savings continue to increase on a multi-year basis, and I think we will, because consumers have to repair their balance sheets. This is the global rebalancing.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.